90% of people who try to daily trade end up losing to the market, with oftentimes many of them having negative returns. Most people lose money in the market not because they pick the wrong stocks, but because they break the fundamental laws of compounding. Today, I'm sharing the 10 principles that separate the winners from the rest. So if you're looking for info on the latest meme stock or day trading advice, you should just close out of this video right now. This isn't the channel for you. This channel is for those who are in it for the long haul and want to make generational wealth to change the trajectory of their family. No shortcuts are here. So in this video, we'll focus on my 10 principles for long-term consistent gains investing. Second, we'll look at the power of compounding. And third, we'll look at the compounding kings of the market. As Albert Einstein said, compounding interest is the eighth wonder of the world. He who understands it earns it, he who doesn't pays it. My 10 core investment principles. The first one is you must leave your emotions at the door. If you're letting emotions run your stock picking decisions, you're going to end up panic selling when the market's starting to freak out from some macro event, or you'll see a stock flying to the moon and you'll end up FOMO buying in, trying to chase the run and end up losing out when it pulls back 40% shortly after. Number two is always zoom out. On the day to day, on the weekly, or even monthly, there could be huge macro events such as inflation, a recession, maybe there's a supply chain issue. When in doubt, as a long term investor, always zoom out because when you look 5, 10, 15 plus years out, all those major events that you thought were the sky was falling are almost guaranteed to just be a blip on the radar. Next, once you start looking into individual stocks, you'll want to focus on really understanding the business. And how you do this is you need to listen to the earnings calls. Listen to what management is saying. Listen to how they're answering questions when analysts are asking them. You need to then read over the earnings reports, understand what's happening in the business. Is their revenue growing? Is their revenue growing quicker than their capex spending? Are they becoming more profitable? These are all things you'll understand when you look at the fundamentals. You need to know what you're invested in, understand the business, understand what products they have, understand what types of customers are buying from them, understand what type of industry they're in, what's the potential total addressable market, are the margins high or are they low in this business? And once you know this, you need to run your projections. What do you think they will have for future revenue growth and profitability growth? What PE do you think they can command? Run those numbers, look at least 3 to 5 years out and see if it's going to beat the general S&P returns or not. Next, once you've identified these top companies that you're really interested in and you're consistently adding to, you need to buy the dip. Oftentimes, we'll get some big pullback every year or at least every 2 years. If a stock pulls back 10, 20% and nothing has changed with the business, then these are buying opportunities for the companies you love. Now, don't just see a random company, drop 60% and assume it's a great buying opportunity. If something fundamentally changed with the business, you need to reassess it before buying that dip. And finally, if you're doing these top 7 things, trust your process. Stick to what's working because over time, it's going to continue to compound. Number 9, allow the compounding to work. You don't want to buy and sell constantly. Oftentimes, you're going to miss the true compounding. Let let the wonders of compounding really work and really have the power of time on your side. For those of you listening that are in your early 20s or 30s, you have many, many years to still go. Have that work in your favor. And finally, enjoy the ride. If you're going to be spending the time to identify these great opportunities, also enjoy the process. There's no need to stress out. This should be something that's fun. Similar to my 10 principles, a lot of these stem from some of the greatest investors out there. So, one of the greats, Charlie Munger, he was the partner with Warren for Berkshire over many decades. And one of his famous quotes was, "The big money is not in buying and selling, but it's actually in the waiting." Looking over at a basic compound example, let's go ahead and run through a scenario. So, in this scenario, the initial investment is about $1,000, and every month after contributing $500. Let's just look at 10 years. Now, 10 years is just the start of when you start to really see the power of compounding. And then in this scenario, let's go ahead and look at 18% interest returns annually with a variance of 6%. So that way we look at 12%, 18%, and 24%. Now, you might think these returns are really unrealistic because you've always grown up hearing to expect 8 to 10% at the most in the market. But stay with me. I'll explain shortly. You'll see real examples of why these numbers aren't as unrealistic as you might have previously thought. So looking at the examples we used of 12, 18, and 24%, after 10 years, you would have contributed about $61,000. But 10 years later, as long as you stayed on track with those consistent contributions, you would have had with if you got 12%, you would have had a little over 100,000, 18%, a little under 150,000, and if you got 24% returns on average each year, you'd be just under 200,000. So substantially more than if you were to just hold this money in cash. Let's go ahead and look at some examples of why these numbers were picked in the example and see if anything lived up to these. So looking at VU down here, averaged about over the past 10 years, about 13%. So this VU is an ETF that tracks the S&P 500, which is largely considered the baseline of expectations for how the market is performing overall. So so if you look at the S&P 500 over the last 10 years, it performed even better than that 12% calculation in the previous one. Now, if we look at the Qs, so the Q is the NASDAQ 100, which tracks the top 100 in the NASDAQ, which is largely heavy focused on the tech industry. And they performed almost 19%. So even better than that base case we were showing on the last slide. And now, if we look at some of the big tech names that I'm sure everyone watching this is very familiar with, the Microsofts, the Amazon, the Googles, all of these over the past 10 years averaged anywhere from 21 to nearly 24% returns on an annual basis. And now, if we're thinking about returns, so that 12% is the baseline for the S&P. Now, if you're getting anywhere above 15, those are pretty good returns for an investor. Now, if you can average over 20% returns each year, then you are starting to get into that category of elite performance where the compounding is really going to start to multiply as the years go on. And as we'll see later on, when the compounding gets going, it really gets going. It's like a snowball going down a mountain. It starts as a, very small thing, but as it keeps rolling, it keeps picking up more and more snow. By the time it's getting towards the bottom, as far as it's gone, it's a massive, massive snowball now. All right, so going back to that previous chart, just so we can kind of put a little bit more of a visual of actual like ETFs or companies with them. So again, 12% is that S&P ETF VU. Now, if we're going up to that 18%, you could think of that was Meta or the Nasdaq 100 performance over the last 10 years. And if you're looking at the 20% plus line, that's really your Google, Amazon, and Microsoft. So real quick, if we just flip back to this so we can see the numbers again, this top line, so your Google, your Microsoft, your Amazon took $61,000 of contributions and turned it into nearly 200,000. Invested in the Nasdaq 100 or Meta took that 61,000 and got to nearly 150,000. And even just investing in the S&P 500 went ahead and got you from 61,000 up to 108,000. So regardless of if you want to be spending the time to put in the work to research and listen to conference calls, even if you're just invested in the ETFs, you can be consistently buying those and still get exponential gains. So if you don't want to spend the time, or you think, going back to these 10 investment principles, if you think your emotions are going to, have you pull out and panic sell when some crash happens instead of holding through it and letting the power of compounding work, then you're probably better off just buying the indexes to avoid panic selling on many of the great stocks. But if you think you can work through these 10 principles and understand it and work up to understanding the business, you have exponential returns possible by finding those great stocks. Now, hopping back over to this. Now, what exactly made these companies get exponential returns, you might ask? Let's hop over to looking into their actual revenue and profitability over the past 10 years. So, if you're looking at the revenue, you can see they did exponentially outperform the market, anywhere from 13% to 24% average revenue growth over a 10-year period, when the average in the overall stock market is mid single digits. If we flip to profitability, the story is about the same, some maybe even a little bit larger of a gap too, and seeing from anywhere growth of 20% to 45% growth over this 10-year period, when again, the average in the market is usually around the mid-single digits. And let's just revisit Charlie's quote again. The big money is not in the buying and selling, but it's really in the waiting. As you saw, the returns are getting exponential, and that was only a 10-year time frame. Let's go ahead and even extend that time frame a little bit more. Let's go out 20 years and look at these numbers. They're getting they're starting to get really big now. If we looked at 10 years before, remember everything was under 200,000. Now we're looking at things just two times more in time, but the returns are way more than that. This bottom line's 4x more, then we got 6x more, and I think this top line's, closer to like a 9x. Now, the farther we get out in the more decades to go, a 24% return is going to get a lot harder, but a really competent investor can still get over 20% returns if you put in the effort. If you look at these lines, 18% is very realistic. If you zoom out just on the NASDAQ 100 ETF, you're still going to get close to 18%. You'll probably be closer to the 15, 16% returns, but that's just for an ETF. If you can identify the great stocks out there for the future years, you can easily get 18% if you put in the work to understand in the companies. Now, just for fun, let's go ahead and zoom it out 10 more years. A lot of times when people run these compound interest scenarios, they look at 30 years because, they're starting to explore it when they're 20, 30 years old, something like that. So they're kind of looking out closer to their retirement age. And wow, these are, for many people, life-changing money. Even in a bottom case scenario where you're only getting 12% from the S&P 500, you're still turning in, so we said 60,000 in contribution every 10 years, so 180,000 about. So you're still under $200,000 of contribution over a 30-year time period, but you're converting that into $1.5 million with the ability to get up to 5 million or even into eight figures depending on the performance you can do. I don't know about you, but when I first discovered the power of compounding, it really inspired me to put in the work to try to explore and learn everything possible about about how to invest and become a better investor. The hours you could put in into learning this craft could translate to multiple millions of dollars. I don't know about you, but I think that time spent is definitely worth it. And just as a reminder, this was not anything crazy in the scenario. $1,000 at year zero, then from there on out, just $500 contribution. Think to yourself, does this seem like a realistic scenario? Can you contribute $500 every month? If not, I would advise reviewing some of your spending. Can you can you make some cuts to make this more realistic? $500 is less than what the average car payment is these days. Instead of buying that fancy new car and having a high monthly payment, can you look for a used car that's, reliable and safe still to either pay fully in cash or get a much reduced monthly payment so that way you have an extra $500 at least? And maybe the scenario is too small for you. Maybe your initial investment, or maybe you've already started investing, and this amount is higher. Go ahead and Google yourself after you're watching this video. Put in the amounts that make sense to you, and just run some scenarios. Put in what you can originally. How much do you think you could do each month, and then start with 10 years, maybe go to 20, 30 years, and really just look at the impressive numbers that come out of it and hopefully that will inspire you to focus on these principles of investing. So I advise you to take a screenshot of this page if you want. If you want to hop back to the earlier part of the video, you can go back to here. Feel free to rewatch this video too, so you can just better understand a little bit more of what the core principles are, study it, practice it, and once you get it down, enjoy the ride and let the power of compounding really work for you. All right, thanks for tuning in. If you haven't already, don't forget to hit the subscribe and the like button down below. Also, let me know in the comments below which companies do you think will be able to get a 20% CAGR over the next 10 years. Thanks. and I'll see you in the next one. Peace.